So there have been many instances where we would have studied company for 4-5 years without buying it.
4-5 years, wow.
Right.
Hello everyone and welcome to another episode of our show. I'm Anupam Gupta and on today's episode my guest is Samir Rachh, Fund Manager Equity Investments at Nippon India Mutual Fund. Samir, welcome to the show. Thank you so much for doing this for us.
Thank you, Anupam. Thank you for having me.
Yeah, let's start with your early career. I see that you started with Capital Market magazine back in 1990. Were you always interested in the stock markets or did it come later or?
No, so actually I got interested in stock market when I was in 12th standard.
Wow.
So I was attending coaching classes. So there was a professor, he was economics professor. So he gave a first glimpse of stock market to me. And then one of my uncle, he was a broker at stock market. So he had come to stay at our place for 15 days. So during that time, I got to interact with him and I got to know more about stock market. And he used to send me to, Nariman Point in those days when I was a kid. And first time, go to Nariman Point, tall buildings and all. So in that sense, I fell in instant love with that space.
Yeah.
So ever since I decided that I will pursue career in stock market.
Yeah, so before you joined Nippon in 2007, so you'd already had about 10-15 years of experience in different places.
Yeah. So
what was that like?
Yeah. So basically, capital market was my dream place. So I came to know about capital market. So when you are first timer, you want to know all about markets. Yeah. So I used to read, newspapers like, Money, Profit and all that. But finally, I discovered this magazine called Capital Market. And Capital Market was a wonderful product. They used to call it scientific investment magazine. Yeah. So everything I learned about the market was by reading Capital Market. And when I was finishing my graduation, I had decided already that I want to join. See, because in those days, there were no formal places. We're talking of 90s. Yeah. There were no formal brokerages or no equity research. So there was one place where you could, get all annual reports. You could meet companies. You could meet industry experts. So in that sense, it was a perfect place, and it was my dream place. I'm lucky that I got to work with them.
You learned everything of annual reports, valuation.
So, everything I learned, basic my foundation, it was like college for me.
This was also a very fascinating period in the market, Samir, because from 1993 to 2003, this post-liberalization, all the way to 2003, the market really didn't perform. And 90s were all sorts of ups and downs happening out there, various kinds of scams. And it's only in 2003 that the market really picked up. You could actually do stock picking. What was that transition like? Any early mental models that you made or any lessons that you learned at that point of time that still stay with you?
Yeah. So basically, see, when first time we're in the market, so all lessons you have to learn by paying the prices. So in those days, market used to be very, very volatile. So we had seen two big scams, 1992 Bharsa Mehta and Ketan Parekh, and then in between some crisis or other. So early lessons, what we learned that in markets you have to book profits, kind of. And I mean, I came to know about, there is some concept called long-term investing much later in my career. Yeah. I wish I could have known about it much earlier. So in those days, we used to feel that if you don't book profit, then jayega sab. So, you develop with that kind of mindset. So maybe we learned a lot of lessons, but some of them were wrong lessons, which we corrected over a period of time as we become more mature. And also, I think what we realized over a period of time that, there are some sectors which are very cyclical kind of sectors. For example, any sectors which are like commodity in nature, any sectors which are dependent on government kind of. So those are the sectors where long-term investing doesn't work, where trading kind of things work. So I think, there are enough number of, more lessons, a lot of lessons we'll learn over a period of time.
What I remember from that era is always that every time there used to be a theme. Right now it's more secular, but at that point of time, TMT theme chal gaya.
TMT theme chal gaya.
Domestic theme chal gaya.
Right.
In that kind of a scenario, what was your research process like? Did you meet managements, get the annual report, primary research, secondary research? Now, of course, it's become a full process. What was it like when you had just started your career?
So see, when I started my career, the capital market was a great place because capital market had their own software. It's called Capitaline. So today Screener is the most popular. So the source of Screener database is the capital market at the background. So that was a place. So this was a place where we had all the annual reports. Then they were really visionary in the sense that they had hired retired industry experts as a consultant in those days. So we could always talk to those consultants, learn about the sector, meet the companies, understand manufacturing process. So those kind of things were really cultivated early on, kind of. And so those were the days when we used to write research and not really invest money.
Correct.
So you learn real lesson when you actually put those lessons to real use and start investing money. So when you start investing money, you realize that there are a lot of things when you work in institution framework. It may not be the same as you're working individually. So there are a lot of processes, this, that. So basically, what over a period of time we sort of institutionalize the process that you basically need to have some like screeners and all based on which you filter and maybe you zero down on some companies. And then based on those, you do more work, you read annual reports, talk to competitors, you talk to experts, and then you further get idea about what is this company all about, what is the quality of the management and all that. And then once you get you're satisfied with all those things, then you start putting money. So I think it's the same process. Basically, it's about evaluation of management, business, and then finally the valuation. These are the combination of these three things, which you can fine tune over a period of time. Like maybe you're doing in certain manner as you learn more lessons, you fine tune it. But at the concept fundamental level, these are the three things.
So that process hasn't really changed from what it used to be at that point of time. Maybe the tools might have changed.
Absolutely.
But the core process of researching company is still the same.
Absolutely.
What brought you to Nippon India, or as it was called at that point of time, Reliance Mutual Fund?
Right. So basically, see, after my job, like stint in capital market, actually I had started on my own. I became entrepreneur.
Oh, nice.
So basically, our idea was that whatever we learned, why don't we like start investing and earning money from that? And since we didn't had that kind of saving, we thought we'll also sell research as well as investment ideas. So we started our own firm called Envicon Research with one of my colleagues in capital market. And in fact, we were very, very lucky. So in those days, you used to have late Mr. Rakesh ji as one of our client and all that. So it was doing really well, like in the sense that we were really getting confidence that whatever we have learned, finally we are churning out ideas on our own, and somebody is investing large money based on that. So it was working pretty fine, but unfortunately my partner passed away.
Oh.
So I was finding it very difficult to continue single-handedly. So then I joined Hinduja Finance kind of.
Okay.
So Hinduja Finance, it was a listed company, and since if you're a listed company, you are supposed to report profits every quarter. So there, what I learned was the timing of the market. Like,
oh, nice.
Like how do you time the market? There, I had a boss who was my ex-boss at capital market too, and he had amazing sense of timing.
Sure.
So I don't know any other person who has that better prediction on index. Like he could predict this is the top of the market, this is bottom of the market.
It's a big skill.
It's a big skill, kind of. So that came very handy. But over a period of time, Hinduja, they lost interest in Hinduja Finance, and this division was merged with IndusInd Bank.
Okay.
So then it was no fun. So then I got opportunity to work with MK, certain stockbrokers. So MK, MK was a specialized mid-cap broking house, so I joined there as a head of research. And again, there also, like my time was going in a lot of mid-cap, small caps and all that. So in that sense, over a period of time, I specialized in mid and small cap. So after, heading research, I moved to the PMS. But in those days, there was a lot of ambiguity on taxation structure, because if you do buying and selling in PMS, it was considered from taxation angle as business income and all that. So it was quite ambiguous, and we were not sure whether we were able to scale up that big. And in the meantime, this opportunity with Reliance came, kind of. So I was recruited by Madhu Kela. So Madhu Kela, whom is one of the most passionate person on equities I know, kind of. Yeah. So he recruited me to assist Sunil on, in those days we used to have one fund called Reliance Long Term Equity, which was focused on mid cap. Yeah. So I was supposed to assist Sunil on mid and small cap. So that's how my Reliance journey started.
Yeah, so you've got Madhu Kela, you've got Sunil Singhania. Yeah. This is a Reliance team in the mid 2000s.
Yeah, amazing team. So Reliance team was amazing. So Sunil, I don't know if you know him. Yeah. He has this amazing skill. So he doesn't read annual report, he scans annual report. So I still remember those days, when we were doing calls with the company. So on one screen of the computer, he's reading annual report. On the screen of computer, he's reading research report.
Wow.
And also switching to Excel sheets in between. And at the same time asking questions. So he really scans the annual report. So in that sense, I think I was very lucky to really get to work with some of these very marquee investors.
And also this was the bull market of 2003 to 2008.
No, so I joined Reliance in 2007.
I know, that's what. So
I had just 6 months of bull market, but those 6 months I distinctly remember because we had become number one mutual fund in those days, and we used to have party every week. Like today this fund has got this much AUM, today this has become number one, today that has become number one. So in fact I had increased my weight by 5 kgs by daily eating those cakes.
And then of course, then you had the global financial crisis, and then the small cap fund was launched in 2010.
Yeah.
Let's roll forward to that. What was that era like? Because 2010, 2003 to 2007, that bull market was really about the large caps. Of course, small and mid caps also went up, but it was really the domestic cyclical story, SEZs, power, infra, all of that. If the previous bull market was IT and pharma, this was more domestic centric. Small and mid caps also were actually small and mid cap at that point of time. What was it like to launch that fund in 2010?
Right. So basically, see, we had this product called Reliance Growth Fund, which is a flexi product, and that product had become too big. So maybe there was need from investors that you want some like a product which can really buy smaller ideas and really create that kind of alpha, and that's where this idea was born.
Okay.
And that's why we launched this fund like in 2010, but it was a very small fund. When we launched it, we I think garnered some 380, 390 crore. Kind of, and you won't believe, like, so as you rightly said, we launched it in 2010 and then the bear market started, so you won't believe the NAV of this fund by 2012-13 had fallen to 7 rupees.
7 rupees?
7 rupees. So this is how we started, like.
Yeah, because it
was a very bad period for the market.
12 was the entire Europe crisis, 13 was taper tantrum.
Absolutely.
And 2014 we had our own issues with the current account deficit.
Right.
So that 3 years was actually, how did you, remove those 3 years?
So basically, since we had not gathered that much money, kind of, the expectations were also low from us. But this market correction provided some real beautiful opportunities of buying some of the great business at a very, very attractive price. So while we were feeling the pain of, whenever like 10 rupee NAV goes down to close to 7, it pains. But at the same time, it gives a lot of opportunities. So bear market, that gives you one of the superb opportunities to accumulate some of the businesses. So we utilized that bear market pretty well, and we really accumulated some of the very good companies at very good price. So when the market bounce back happened, we really, started flying kind of. So I'm very happy that that happened. Like that allowed us to buy something at very, very attractive prices.
You kept the process the same of bottom up, stock picking, good
so
companies.
This was always a bottom up. So see, in small cap, this benchmark investing is not an idea. You don't manage small cap fund. You manage large cap fund. There's no top down. It's always a bottoms up. But at the same time, you do some risk mitigation by doing some balances in the overall sector weights and the kind of liquidity profile you want to maintain.
Sure. Fast forward to 2018, I think that's when Sunil left, and 2019 when the Nippon acquisition happened. A lot of changes in a very short period of time. What was that like?
So basically, see, as I told you, like it was a very small product kind of, and Sunil used to run a very big, he was CIO also, and he used to run a big product like Reliance Growth Fund and all. So this, since it was those small product, I'm very lucky that he gave me a lot of opportunity to work on that. So like I was looking at this product for very long. So for me, it was like, in that sense, the transition was very smooth. Like we didn't had any major, of course, his guidance we always miss kind of. But in terms of transition, and also Nippon also, they didn't interfere in day-to-day management. So we had a best of both kind of. So like it was a entrepreneurship of Reliance as well as a processor of Nippon. So we once Nippon came, we introduced even stronger risk management process, and like Japanese work in a very methodical manner.
Correct.
Whatever best of that which we thought will enhance the product profile and like help us manage risk better. So we use that. So in fact, again, like very lucky to have a very smooth transition.
It's very interesting, because when we look back at the 2000s, when 2005, 6, 7, at the peak of the bull market, when Reliance Mutual Fund at that point of time had some of the largest schemes. 20 years later, you're managing India's largest small cap mutual fund. So it's like you've traveled a lot of distance. In that. When you look back upon those days now, what do you miss, or what do you look back at in the most fondest manner?
Right. So in those days, the competition was much lesser kind of. So you had opportunity to really create a difference here. Like if you're one of the first one to identify and real. So now there's a huge competition. Now we have like 30 small cap funds, and plus we have this competition from HNIs, we have competition from all these PMS, mutual fund, AIFs kind of. So I think there is nothing which is yet to be left to be discovered kind of. So you have to really work hard and think even longer term kind of. So I think the kind of valuation at which we are traded, they are so expensive that you have to really give long term time to really make money out of it. So I think some of those easy ideas like sitters, they are difficult to find.
I was looking at some of the fact sheets from that 2005 era, and you could see, that Reliance Growth Fund, Reliance Vision Fund, Reliance Long Term, they had AUMs at that point of time in beyond 10,000 crores, which was a big deal at that point.
Right.
I don't know if there were too many mutual funds of that era which would command that kind of AUM, And I'm just trying to think that what was that like for you to operate that small cap mutual fund in the shadow of such larger schemes? It didn't make any difference at all in terms of.
No, so in that sense, we have very great work culture, right? Reliance, Nippon, whatever we call. So we all help each other, kind of. And while there is healthy competition internally, it's not like goes to the extent where we don't help each other, kind of. So I think I had not such any challenges, and fortunately, they are very well defined space. Kind of over a period of time, SEBI made it very clear on what is large cap, what is mid cap, what is small cap. So that intersection of competition in that sense is not there. So we had all our spaces for all of us.
And the sales and distribution teams are also very comfortable selling the scheme or.
Right. So small cap, small cap has come a long way. So it was looked as a very dirty space, and for right reasons. So, there was a time when many of the large investors, they will completely ignore this space. इसमें सब कचरा कम नहीं आता है, अपने को उसमें नहीं जाना है, kind of. So from that time to today, it has become a mainstream category. So we have come a really long way. So a lot of things have happened because of which this change has happened. So one thing is that SEBI gave very clear definition: what is large cap, what is mid cap, small cap. So top 100 companies of market cap, large cap, next 150 are mid cap, and the rest are all small cap.
Everything else.
So small cap is very large space. Today, like between 4,000 crore market cap and like 30,000 crore market cap, where small cap cutoff happens. There are 500-600 good companies. It's a very large universe which you can't ignore. Kind of, if you're a serious investor. Secondly, what has happened over a period, the quality of promoters have changed. So in many companies, maybe it was started by grandparents or parents of the current generation. And this generation, they're studying in the best of the colleges abroad. They understand the importance of communication. They understand the importance of market cap. So they all focused on, so basically what happened, because of that, there was alignment of interest between minority shareholders and promoters for the first time. So that changed the experience of this space, kind of. So there are a couple of good things which have happened. And I think post GST, post Demon, promoters realize that, it's better that you invest all your money in the company and create a market cap, because market cap is a real currency. Kind of. So because of all this thing, it has over a period of time really become a mainstream category. And post COVID, I think somehow the amount of return this category has generated, I think, because of which the expectation, as you rightly said, they are running very high, kind of. So that also creates a burden of expectations. But I think the small cap category is no longer small, it's just small in the name. And in terms of maturity, we have traveled a long distance.
I mean, if you look at the AUMs today, in today's day and age, in the equity category of mutual funds, I think the largest categories, if I recall correctly, are sectoral thematic, small mid cap, and I think ETFs. ETFs obviously because of the PF money going there, but to have that kind of preponderance of AUMs in that category shows that it's matured over the last 20 years. I like the point that you raised about there being just 500 to 600 stocks. What is your process? Let's move to that part now of stock selection, because as you had said, this is pure bottom up.
This is pure bottom up. And also say, so in small caps, it's not necessary that, if you follow all your processes and you zero down on some stocks. And if I tell my dealing team that, buy this stock. So it's not necessary that you are seller available on that day. So I always tell this, in small caps to invest in one company, you have to do research on 5 companies. So in that sense, it's one of the most research intensive category, kind of, because it's not necessary that if you like the company will get float. So there have been many instances where we would have studied company for 4-5 years without buying it.
4-5 years, wow.
Right. But one such one chemical company which really made a good amount of money for investors. So we kept on meeting them for 4 years, but we thought they were implementing one very large project which had a large gestation period and all. So waited. Finally on Demon day, stock price fell from 130 to 80. In that period, market was bad, and 80 rupees somebody was facing redemption issues. So my dealing team called me that today some large block is available. So then we took 10 seconds to decide. So if you wouldn't have done all that work in 4-5 years, you wouldn't have been able to respond. So you have to keep on doing work, wait patiently when that opportunity comes. And when that opportunity comes, you have to be very agile. So you cannot start your work once your dealing team calls you that there's block available. So you have to be really prepared.
But Samir, how does this work? Because you don't do cash. You don't hold cash.
So we don't take cash calls. We normally around 5%, that's the max. Sometimes we're going to 7% because we very strongly feel that cash call has to be taken by investors. See, if cash call goes wrong for a fund manager, it is carrier at risk, because the investor can always tell that I have given you money to invest. So why are you holding cash on my behalf?
Yeah.
So that's not fund manager's job, at least in mutual fund structure.
I'm just trying to figure this, because in small and mid caps, pricing, the price at which you enter is important, but in case of placing a very large order, executing that itself can take quite some time. So how do you manage this?
So basically, see, I always see the small cap fund managers, they are not choosers, they are beggar.
Beggars.
You have to really, really.
जो मिलता है ले लो.
जो मिलता है, जितना मिलता है, you have to, buy, and you have to wait patiently. You never know, when market gives opportunity. Sometimes there are wars, sometimes there are liquidity pressures, sometimes there is something facing margin issues. So you have to wait for those kind of opportunities. So I think it's very important. That's why, in small cap, we always tell that if you're coming to small cap space, come with long term in mind, because of, I think, the sizing issues and the liquidity issues. If you really give it a short time, you won't get full benefit. So if you want to come to this space, take at least 8-9 year view. So then you'll experience real beauty, because if you get that amount of time, you'll be able to reflect in terms of buying, selling, and taking those investment decisions.
I want to talk a little bit, Samir, about position sizing. You've got a very large portfolio, but I think that when I compare the portfolio today in 2025 as compared to what it used to be in 2010, it's become slightly bigger, in the sense that in 2010 the tail was really long. And each position also, you had the luxury of putting in 2%, 3%. Yeah. Today now, if I look at your portfolio, the construction is totally different.
Yeah.
Walk us through this journey.
Right. So see, when you're a smaller fund, you can run it in a little more concentrated. So in small cap, I think you have to always diversify. So again, I'm not a very big fan of very concentrated strategy in the small cap space. The reason being, see, in small cap, you have to hold stocks for a longer period of time. So that's when it multiplies. And say suppose if you buy one stock and that eventually goes up by 50 times. So that 50 times journey is never one-way journey. It's never smooth. So there will be at least 4 or 5 occasions in between where stock price in the interim would correct by 50%. So what do? Suppose if I buy a very large position in stocks, it's a 5% of my fund, and in the interim it falls by 50%. So if I am having 5% position, it falls by 50%, it will take 2.5%. 250 basis point return. So then I'll be forced to react, because I cannot allow that kind of return to go.
Yeah.
So when and if I'm lucky, I make it a buyer also, and if I sell also. But then price comes down by 50%, and if I call my dealer, say whatever you sold, you buy back, he said that there is no seller. So you have to live with this. If you've got one good stock, you have to live with that interim fluctuation. So if you're running a very diversified fund, say it's a 1.5%. If it goes down to 50%, what happens? It's just take 0.75%. So what it does, the diversification allows you to hold your winners for a longer period of time. Yeah. And at the same time, it's not that each and every stock we buy, it goes up. And many times we have seen, some of the stocks which are holding in our portfolio, while we are holding, they have fallen by 90%. Wow. Or whatever. I mean, they are not bad companies.
Correct.
They are good companies, but a lot of things happen around. And so you have to keep on reminding yourself and revisiting whether your hypothesis has gone wrong or something. Sometimes you may get an answer that, while you may have made some mistake, it's not bad, a company will bounce back. So again, so basically what it does, if you made any mistake, if some stock price goes against you, you're not unless again, if I had 5% position and it falls by 90%, 450 basis points. So it allows you to, even if some of the stock ideas goes for a toss, you don't go out of the game. Yeah. So I think diversification in small cap space is a virtue. The only thing what it does, that if you become too diversified, so then generating alpha becomes very, very challenging.
Yeah. So for our audience, who probably doesn't know the skills of position sizing, portfolio management, how would you explain the difference between diversification and concentration of your portfolio? Both have some advantages and some disadvantages. Just explain that to our audience.
So see, in mutual fund structure, because we are managing large sums of money. So if an individual investor, maybe if he is able to trade his quantities and all, you can be aggressive. But once you get into the trading kind of mindset, you don't know what you're missing. So sometimes market can surprise you positively, unbelievably. There you never know. Some stocks can be 20 beggars, 50 beggars, 100 beggars. So if you have this habit of booking too much profit, you will never going to have those beggars, and then it's not going to make a big difference to portfolio. So So I think the good thing about this is that in an institutional structure, when we're thinking long term and we're absorbing all these ups and downs, in the process, like we held some stock for a really good amount of time, and some of them turn out to be real big winners, and they make a meaningful difference, kind of. So, like if you sell something, then it's not never going to become 100-bagger. So for some stock to become multi-bagger, you have to hold on and go through all that pain. It just sounds very easy, but when you practice it, it's very difficult.
But also then if you're that diversified, even if one stock in your large portfolio goes up 50 times, the overall performance is really not that.
Yeah, so I think that's a challenge. So I think, as you rightly said, I think one of the outcomes of a very diversified portfolio, it becomes very ordinary portfolio, and it becomes very difficult to generate alpha. So the only secret is that you have to continuously bring winners in your top 25, top 50. So like you have to be really on your toes. Like if you feel some sector is going to, like now start doing well, you have to make sure that you are increasing the weight. Similarly, some stocks now you feel this time has come, like you have to really bid it up. So you have to try and bring it up. So if you look at, if you're creating diversified portfolio, the amount of risk which you're taking is much lesser.
Sure.
So overall risk adjusted return which you're generating, is significantly superior. I think the only secret is that you have to bring winners in your top 25, top 50. That's the only way.
Experience counts. You've been doing this now for more than 15 years, I guess.
Yeah, but experience, sometimes it can be enemy also. Like, so in very long bull markets, experience doesn't work. Like it goes against you because you may become cautious, like much before than what it's required. So you have to really stay agile and you have to know when you have to use your experience and when you have to keep it aside. Like,
let's jump into that because that is what this series is also about. The challenging times in your career when some of your calls have gone wrong.
Yeah, so there have been. So what happened? Like, I think in between we launched a couple of closed-ended funds.
Okay.
So this markets had really gone up. I think somewhere in like 2012-13. So our idea was that there are a lot of companies, smaller companies. We are not even able to buy in our small cap funds. And these are really cheap stocks. So like, why not we create a separate closed-ended fund there? And what we did, we kept 20% of that fund to buy 3-year index future. It was 3-year closed-ended fund.
Wow.
So with that 20%, we thought, okay, that 20% we can create that 5-time leverage, and if so this will give 20% will become 100, give return of 100%, and this will give. So this is the best of both. So that 20 becomes 0.
Wow.
So you won't believe, like the NAVs of those funds had fallen to 4 rupees.
NAVs of those funds had fallen to 4 rupees.
So it was a real struggle for me to make sure that within the 3-year period, we give back investor positive return and like 10 plus, like at least if nothing, no losses kind of. So, and I won't believe, like, when we were selling this product, like one marketing call I had done from my home, and my wife was listening me, and she liked this idea that by investing 100 rupees you get return of 200. So even she had put money.
Wow.
So it was not skin in the game; it was head in the game. So luckily, whenever investors used to ask me, like how will recover, I said, don't worry, I have to daily report, I have to go home. So I'll work really hard. So somehow we bounced back. So that was one period. Secondly, we had in between raised some large sum of money for with this sovereign government of Kuwait.
Okay.
Kind of. So in that fund, like we started scaling up mid and small cap in 2018, just before COVID.
Yeah.
So we bought a lot of hotel stocks and a lot of cyclical stock. And just after we bought, COVID happens, and some of the stocks fell by 40-50%.
Yeah.
Kind of. So it became the bottom performing fund. But fortunately, we could navigate and we could make it again a top performing fund in the entire Indian allocation. So there were some challenging time in between. Yeah. But I think you have to keep your cool and somehow find out your ways. Market gives you opportunities, so you have to really use it well. You
also earlier said about how you've seen instances where some stocks in your portfolio have fallen by 50%, fallen by 90%, and then you have to take a call as to what to do. In your experience, what are the reasons why these price actions happen? They could be, if you look at it in terms of categories, there are only 2 categories. One, related to earnings. Second, related to liquidity. Like you said, large block comes out, price falls.
Yeah.
And first is more fundamental. In your experience, what are these categories like?
Yeah, so see what happens, sometimes some of the categories, there are a lot of expectations get built up. And if companies, they'll fail to leave those expectations. So, sometimes all trouble comes together. So then this is on telecom companies where we had seen 90% fall in between. So there, they were expecting some orders from the government, which got delayed. They were expecting payments from the government, that also got delayed. They had plans to develop export market. Somehow that also got delayed.
Wow.
And we had a bear market. So at a combination of these four, they started making losses instead of profit. So when you have losses and your expectations running high, so we saw like huge drawback with very low volumes. So you have to live with it. So fortunately, we kept on revisiting. So only good thing about that company was that it had its own patented products.
Okay.
And we thought, in telecom space, if some company has that, really R&D focus and all, it has value and it will come back. And fortunately, it bounced back and it got acquired by a big group.
Wow.
Kind of. So it really paid off. So, you have to revisit your conviction. So it's not necessary always that, all companies which fall by 90%, they bounce back. So you have to keep on revisiting it and you have to make sure that you're not made a mistake. Sometimes it happens that, after you bought, you discovered that there's a mistake or, something has changed permanently in that industry. So you have to take calls. So one of the lessons which we have learned over a period of time, that, you have to identify your mistakes early and like cut them off, because, the amount of time which your mistake takes, it takes away your focus from other 5 ideas, which could have generated much more alpha for you. So, on negative ideas, you end up wasting more time. So you have to just make sure that your bandwidth doesn't go and you recognize your mistake early. So that's a balance which you have to achieve.
And the fact that you've beaten the index mostly over that 15-year career of yours seems to indicate that your conviction and your judgment have mostly been right. Okay, when you make mistakes, there's always a chance that you're doing type 2 errors, which is like your action is right, but the reason is wrong. That kind of thing. But you seem to have kind of mastered that also. In your career so far, in general, has your experience paid off? Like when you can see an event happening, that that's a mistake. And the call that you take, that's mostly been right.
Yeah. So I think, fortunately for me, I think taking calls. See, market, nobody can predict if COVID is going to happen, or war is going to happen, or Trump is going to do. But I think there is a real amount of work to be done on assessing the management quality. I think that's not science; it's a science plus art, kind of. So I think when you have years of experience, when you meet people, you learn to know more about them, and you start analyzing and all that. So fortunately, so far, I think our judgments on people have not gone horribly wrong. There have been a couple of cases where it has gone wrong, but by and large, I think it's been in tune. And fortunately, we also have a bull market. So I think a real test can, for whatever we do, it comes in a bear market.
So if you make a laundry list of reasons why small cap companies, I don't want to use the fail. Let's just say that they make mistakes. One could be promoter decisions. One could be, headwinds, unexpected headwinds. So in general, what are the kind of risks that are unique to the small cap space?
So what happens, scaling up a small cap business, it requires real entrepreneur skills. And when they go through bad times, many people may not have it in them. So you realize that, these people don't have it in them, kind of. So those are the things. Sometimes what happens, like something changes in the sector.
Sure.
So we had invested in one logistics company, where so when this current government came, they were finding out reasons of why India is, such a less investment is coming in India. So one of the reasons they discovered is the logistics costs in India are very, very high.
Yeah.
So they decided to start direct delivery from port, and they cut off CFS.
Oh wow!
And we had invested in this CFS company, which was like really having very good location near port. So we thought a very strategic location, and that location become useless overnight. So there was a change in the government policy. Sometimes something goes wrong with the industry, kind of. So then, and sometimes promoters lose focus, and I think the real challenge comes nowadays that promoters come really trained.
Yeah.
So today promoters are trained properly. That if you're meeting this fund manager, this is his style of investing.
You know what to talk.
These are the kind of questions he will ask, and this is what he likes to hear. So you exactly told what you want to hear. So I think in those kind of times, this channel checks, they become very, very important. So over a period of time, we have put a lot of focus on that. So whenever we create any large position, we make sure that, you've spoken to unlisted competition, because unlisted competition, they don't have any vested interest. So many times, when you hear some bad news, if you call company, he said it's a temporary, we'll manage, because senior management nowadays have ESOP. So they have also interest in stock price. Whereas if somebody is having unlisted company, he says, there's a very serious problem. We don't know how we'll face it. So you get a lot of real good ideas. At the same time, when we speak to, suppliers, employees, everybody, get to know good picture. So like I had our company had organized this Harvard course for us.
Okay.
So there, Professor Pellipu, he made a very
Krishna
good
Pellipu,
point. Like he said, good businesses, they add very significant value. So they add value not only for shareholders, they add value for employees, they add value for suppliers. So overall value, if they add, is really high, then they can distribute to all. So then there is a good company. Then everybody is happy. But if you add very small value, you have to take something from employees, something from the supplier, then then those companies, they don't make too much value. So you have to really make sure that companies are really focused on that bigger value creation.
When you said this, it reminds me of the fact that finding these companies that really multiply exponentially. Okay, like one example obviously comes to my mind is something like a Bajaj Finance. It started as something, became something else, and then it just went on and on. I'm just trying to think in the universe of what I think the 5,500 companies are listed on the exchanges, out of which the investable universe would be much lower than
700
that.
and 800, not more than that.
In your experience, handling a small cap fund, what do you think the chances are of this becoming a large cap company at some point of time in the India that is today?
Sure. So that's the whole idea of investing in small cap, that while you bought something, it's small, and while you're holding it becomes mid cap and it becomes large cap. But unfortunately, we have to keep at least 65% of the corpus in small cap at all a point of time. At the same time, we make sure that we have some space for mid caps, and then we have space for large caps. So we do want to hold some companies till the time, so we want to really demonstrate that when we bought, they were small cap, today they are mid cap, and there are one or two cases which have already become large cap. Maybe they become large cap, again they become mid cap because of market correction, but it's possible, kind of. So we do create some space, but at the same time we have to keep on balancing the portfolio. So we cannot allow it to become multi-cap portfolio. It has to remain small cap at all the point of time.
Obviously. So, one of the things that I hear a lot from fund managers is that, that between bull markets and bear markets are in fact better.
We love bear markets.
Yeah.
We pray for bear market.
Just help us to understand that psychology.
Right. See, because I think the maximum amount of mistake are made in a bull market. Because your bull market, you may get carried away. And anything worth 100, you may be buying at like 90, 95, 100, 120. Whereas in bear market, buying 100 rupees worth thing at 80, 60, 50, sometimes you're lucky 20, kind of. So I think for fund management, it's very important what you not do in bull market and what you do in a bear market. So we love bear market because that allows us to really pick and choose, and it also gives us some time. See, because in bull market you expect to respond too fast, and at the same time to take the organization along and maintain those processes, and also sometimes we may not be that agile, kind of. So we may be missing a lot of opportunities because of that. So I think like as a fund manager, because we are telling investors to invest money for a long term. So as a long term buyer, you want to buy as cheap as possible. So at what price you buy the asset is one of the very, very important decisions in the final outcome.
Yeah. But you're not getting flows in a bear market. Bear market mein kisi ko interest
No, so I think that way there is a good amount of maturity among the Indian investors. I must say, like Indian retail investors, the kind of maturity which we have seen. So I still remember like 10, 15 years ago, whenever market used to fall, we used to get calls that, kya kare? Redemption kar de. Now, 10% fall and we're getting calls like, dal de paisa. So, retail investors have shown unbelievable amount of maturity. They're really thinking of long term. And surprisingly, they're withstanding this interim fluctuation with a lot of maturity, which I don't see in many of the HNIs. HNIs because they perhaps have too much of information and they want to really respond and act on each and every of this information, whereas retail investor is calm and patient, is doing his work and peacefully investing.
How have small caps evolved as a space to invest in? When you started in 2010, where you are now in 2025, and maybe looking 10 years down the line, how do you think this space will go? And I want you to talk to me about two things. One, promoter attitude and quality, which you've already touched upon. And second is maybe new sectors coming in.
Yeah, so I think the most interesting part about the small cap we just touched upon, see, all the new sectors, when they start new, they essentially start with small cap and eventually they become large cap. So since you have experience of 30 years in the market, so when entire IT sector, when they came out, there was no industry in 90s or 80s. And then in mid-90s, companies like Infosys came out of the IPO, and they come out of the IPO, they were smaller companies.
Very small, yeah.
And they were become large cap. Similarly, this government of India, like when I was a kid, there were no private sector banks, there were only PSU banks. Then government of India, they decided to
banking license
to private sector, and HDFC banks of the world emerged. So, a lot of these new sectors, they start from small cap, and that's where the real excitement is. like only challenge nowadays is there is a lot of private equity money which is floating. So a lot of small companies, instead of directly coming through IPO, they're going through first private equity route. And once they go through private equity, they become very mature. Like there is no innocence left in them, kind of. So that I think we like some innocence in the promoters, because that allows us to really pick them up. So when somebody comes very well trained and to really get truth out of that, it becomes more challenging, kind of.
And you can make out also that this company has already seen one level of growth, because I think 10, 20 years ago, the port of call for any small company would either be debt, loans, or equity. Now at least there's this slice of funding that has gone to private equity, venture capital. Now you've got them coming in through that. So in a way, is that good? Because to some extent the promoters' attitude is aligned with minority?
So I think, if I have sounded like that private equity is completely, so I think some of the private equity is a really good one. So they really mature the company. So when they come with the public money, they're really good adult companies. So they know like what they want to achieve, like way they want to achieve.
Sure.
And they have sense of purpose, and they also given good lessons in corporate governance and all. So in that sense, the risk which you used to take in small cap investing, where these promoters are not trained, were high. So nowadays, if you invest in those companies, maybe returns are also less, but risks are also less. So there is a trade-off.
Do you think some of the promoters of the family-held small cap companies, family-held businesses, you think that somewhere the second, third, fourth generation will not have the same vision as the first one? Because if you recall, Mr. Kotak had also said that he's not seeing that in the third generation, that they want to continue the business. You think there's any risk from that?
So it depends. I think one of the biggest theme which we really keep a good close eye is that if there is a change in the generation. So sometimes
succession planning,
generation change can bring a lot of change, because some of the groups are very traditional. So Murugappa group is one classic example. I think we had a generation change in the and I think that's true in many of the groups, kind of. So generation change could be interesting also, but at the same time, there are many families where next generation is not at all interested in business. So what they are doing is like maybe they're giving it to professionals, they're giving ESOPs to professionals and allowing it to run like an entrepreneurs. And this family oversees, which is also a good arrangement, kind of, because there is alignment of interest, because they make money only if company does well. So in the sense they act as a trustee, kind of, for a minority investor. So that's also a good situation. The only thing is that when next generation is not interested, but current promoter is too close to company and doesn't want to sell also, kind of, that's where maybe business doesn't achieve its best potential. So that's a situation we have to be really careful.
How has life changed for you from handling Nippon India Small Cap Fund with AUMs at 500 crores and handling it now with 65,000 crores?
Right. So actually, you have to keep on forgetting the AUM, kind of, then it works really better. So I get this question about AUM, ever since this fund has crossed 10,000 crore. So I tell people that, now India is no longer small, like economy. We are the fourth largest and soon going to become third largest. So all of us will have to get used to size. But having said that, there are challenges also.
Sure.
Kind of, because we're running a 68,000 crore fund. To invest 1% of AUM, you have to buy stocks worth 680 crore. And to create 2% weight, you have to buy 1,300 crore plus stock. And like when you buy 1,300 crore worth of stock and something goes wrong, there is no liquidity. So that keeps on bothering you. And that's why, maybe what you call very diversified, perhaps over diversified, some people may call it, kind of. So that's the thing. And say it becomes a little challenging in terms of see, for me, like 1% of AUM is 680 crore. If my team really works hard, we have a very strong research team, by the way. So, if they really find a good idea, and if I'm able to buy 680 crore worth of stock, and that stock actually doubles, it creates 1% alpha for me, with 1% of the AUM. Same stock, if it's bought by 5,000 crore fund, and he buys only 250 crore worth of stock, there's a 5% for him of his AUM, and that stock generates 500 base for alpha. So when somebody is comparing our return with those returns, and then it becomes a little challenging, kind of. So that's why we always tell investors that don't give all your money to us. If we can have 250 stocks in portfolio, 230 stocks in a portfolio, you can have at least 5 small cap funds in a portfolio. So you also diversify, so you get best of everything.
It's something fundamentally changed after COVID, right? If I just look at AUMs of the category, or even yours for that matter, it just went up exponentially in the last 5 years. Given that small and mid cap funds just run in cycles, and you had one cycle, I think in 2013 to 2018 on the upside, you had one on the downside from 2010 to 2013. Where we are now, how do you see this space evolving? Where are we in terms of the cycle?
So basically, see, because of the kind of experience this space is given, the expectation from this space is very, very high, kind of, which is not a great thing because valuations are not that, where we can make a really big difference in terms of buying something cheap and that getting re-rated over a period of time. So I think these are times we have to be really careful, I think, and just not go by like past returns. So we always tell investors that don't invest very big amount of money in small caps. So like look at your risk profile, and normally the small caps have about roughly 15 to 18% weight. So say for a person with average risk profile, that kind of return, that kind of allocation is enough. So we tell investors that invest only that much portion with which you can see 50% fall in NAV without you losing sleep over it. Because anything goes wrong in the world, small cap will be the first space to get affected. Because suddenly everybody wants to sell and there are no buyers, and with low volumes price can fall. So you can lose NAV at very, very fast pace. And if you lose your nerve in a bear market, which is the best time to act, then you won't make money, kind of. So I think it's very important to communicate two things to the investors, that come to this space with a long term and maintain an allocation discipline. However you're bullish, don't put all your eggs in one basket, because something can go wrong unexpectedly. And be mentally ready. You have to lose 50% of NAV. You can lose any point of time. Like we have not seen it of late, but we have to be prepared.
That's the point, right? At the peak of the bull market, everybody is confident that even if they lose 50%, there's no problem because their portfolio has doubled.
So I think real test of all this will come when we see real bear market, and I hope we don't see it in that sense, that big bear market, but let's see.
You have seen some
we have seen such drawdowns in the past.
If you were to give
which we are much smaller at the time, so now we are much bigger. So the impact which will have like on a wider like amount of investors, so that really remains to be seen how they behave if it's a genuine bear market comes.
So just help our audience out here. What was it like the last time around? In terms of having a bear market in small mid cap, how long did that last? What price erosion did you see? And
So I think in individual stocks, even in this market, we have seen even when things have turned around, we have seen 30-40% falls. But somehow at index level, something or other has gone up, and at index, it's fairly maintained kind of. But in the past, like there used to be very, very severe bear markets, kind of. So I think because of all these reasons we discussed, the quality of companies have changed, risk in the small caps have, in that sense, have really reduced because there is alignment of interest between promoters and also. I think at index level, I think 30-35% fall is something which will attract a lot of money.
Okay.
Kind of. So, like at this point of time, I don't see any reason, but you never know in the markets, kind of. So I think as we go forward, volatility in this space will be lower than what it used to be, because see, we were much smaller economies, and then we used to have a lot of changes in the policy, and our balance sheet also not used to be stronger. So in India, a lot of sense is becoming stronger and stronger. So when you become stronger, the shock absorbing capacity of the economy itself goes up, kind of. And I think the new flow of money is also coming, and like FIs are yet to come fully in small caps, so someday they will also come. So let's see. Very interesting.
You spoke about a sharp fall at the index level. Does passive investing work in small caps?
So see, passive investing will work in if you have a very big bull market. So because small cap, there are 250 stocks in Nifty, small cap 250. So fund managers will reject at least 80-90 of that because it won't meet its quality profile or liquidity profile and all that. In a bear market, when they're in last stage, all the stocks goes up, and the active fund manager will consciously avoid. So these are the times when he'll underperform. Whereas like passive fund managers, he buys each and every stock, and so he will beat active fund managers in those. So there are some times where passive investing will work, mostly in a very big phase and last phase of bull market.
Okay.
But I think there is a ability to make a difference for an active fund manager over a period of time in this category, because if you really choose in this space, and if you're really able to pick up the winner, it makes a lot of difference to the portfolio.
So you gave one very important tip to our audience, which is that allocate that part of your portfolio where you're comfortable with losing 50% of value in the small cap.
Because then you'll be at peace.
Yes.
So once you say, if there's NAV in mind, you say कि 50 का नहीं है, आज के दिन में पकड़ लो. So you're at such a pace, then bear markets are not going to affect you. So then, your ability to think rationally really goes up.
Sometimes I wonder when you hear that advice, I just think that today that equities and stocks and mutual funds in India have become so widespread that people 10% falls, डालो पैसा, 20% और डालो, तो 50% तक तो किसी के पास पैसा ही नहीं रहता. So
like,
how does one handle that?
No, I think there's still a lot of money to like really. So I visited one PSU like 1 year back, kind of. So and it's one of the very big defense PSU, one of the largest defense PSU in India. And I was chatting with their senior employees, and I was just chatting with them and said, "Where do you invest money?" So you wouldn't believe they are not invested in mutual fund yet.
Wow.
So recently, just last week, I was in Delhi and like I was waiting for my flight in the lounge, and like the table was big, and some of the air hostesses they also sat there, and their flight was also delayed. Kind of. We were just generally chatting. So I was chatting with them that, what do you do with your money? Where do you invest? And you'll surprise, they're not investing in a mutual fund. They're investing in gold.
Wow.
So
that's been doing well.
That's why I think you're the best asset allocator for last few years. But I think there is still a good amount of money which will come. And as I think, like there is per capita GDP starts going up and people start having more income. So those money will also come over a period of time.
Right.
So.
Okay. For our audience, how should they choose a small cap fund and hold on to it? Right. Choosing तो फिर भी चलो आपने कर लिया. Then there is this habit of every quarter, every day, every week क्या NAV है, beat हो रहा है नहीं हो रहा है, friend के पास ये है, उसका portfolio ज़्यादा अच्छा है. Just two things. One, how to choose a good small cap mutual fund scheme, and second is what kind of a attitude, what kind of a thinking process you need to have to hold for the long term.
So I think that attitude is must. Like because what happens, like if you do in and out, you also like invite tax incidents, and they can take away a significant portion of return over a period of time. So it's in the interest of the investor to really think long term, kind of. And eventually, like your purpose is not to earn daily bread from it. You are basically investing for your child's education or your daughter's marriage or for retirement, which is going to come maybe 20-25 years down the line. So you think long term, that really helps. It's very mature behavior, and it works in the interest of the portfolio. For me to comment on which fund manager is good and all, because I am also interested party.
Process of choosing a small cap fund.
So process of period. So basically look at a long-term track record. Okay. Also maybe nowadays all informations are available, like on what stock picking each fund manager does. So just pay attention to that. Like you have to really find out either somebody is taking really extraordinary risk to generate that alpha, then sometime in bear market that can affect kind of. So, and also as I said earlier, I think create a diversified portfolio. Don't put all your money with one fund manager. Like if you can have 230 stocks in our portfolio, you can have at least 3 or 4 asset manager within each space. Like so, too diversified. So you will get best of everything.
Having diversified the other thing, and which you would know because your churn has been historically quite low. I don't know how you manage that, but when you have such a big pool of stocks and you've got a small cap fund where I don't know, maybe constantly churning might give you beta, might not give you beta or alpha, whichever it is. What's your advice then for holding on to that and not doing this churn every whatever?
See, I think churning is something which is not in the interest. As I said, it involves tax incidents. So that happens. And what happens? See, it's not possible that one fund manager is going to do well year after year, each and every year. So every fund manager will go through some bad phases, kind of, and then he may come back also. So it's impossible for anybody to really figure out that this is a fund like which is going to do really well in next 1 year. So if you're really able to find that and invest, and that's why you create it, because you don't know. So basically, just find out, guys. Nowadays a lot of information is available. So you just observe them, and if you like their investment style, and if you feel it's making difference to the portfolios, be with them. So as we are there with the company during good and bad times, I think even investors will have to be there with a fund manager in his bad or good times, both kind of. So then he'll get real benefit, I think, over a period of time.
So if I were to just summarize that into 3 virtues, I can see patience, discipline, diligence as 3.
Absolutely.
3 of them, So absolutely. That is something for our audience to take away. How do you maintain that? Where does Samir Rachh go when things are not going right and needs to be grounded and needs to just chill out maybe?
So I think one of the important jobs of the fund manager is to manage themselves. Kind of. So these are the times where to really manage yourself well. You have to keep that faith that things will be fine. I think it's very important. I think Sunil used to say, you have to be really optimist to be an investor. So I think once you become pessimist, then everything you will see it as red, kind of. So when things are really bad, you have to look at beyond and say, okay, this shall also pass, and normally passes. See, fortunately in India, it's a country which is at the cusp of turnaround. We have demographic plus, and we have such a good government which is a proactive. And, a lot of things are aligning for us. So I think we are very lucky to be in this country at this point of time, where this economy is just lifting up. So I think that gives you added reason to keep that faith.
What are some practices that help you keep your faith? I don't know, yoga, going for a walk, watching a movie, listening to music,
I think,
reading a book?
Read spiritual books like Bhagavad Gita. Reading really helps. So I think there is a very close resemblance between, because market is finally, it has a lot of connect with philosophy, kind of. So karma, also theory of karma also works beautifully in market. So I think, and of course like yoga, and I think one thing which I think all of us realize over a period of time is that your health is also very important. So all of us will have to pay real good attention. So sometimes we may take it for granted, like many of us in pursuit of our work, but that's not a great thing to do.
आजकल तो लोग सिर्फ portfolio health का देखते हैं ना, खुद का तो थोड़ा सा.
I think एक बार कुछ बीमारी लगेगा, then you have to really go through that.
If you do not want that bimari to come, folks, like Samir said, be patient, be optimistic. That I think is one of the best takeaways that you can have from this episode. You already know how to choose your portfolio, and you can just rewind to some of the tips that Samir gave to have a much better understanding of how to handle the small cap part of your portfolio. With that is a wrap on the show. My guest, Samir Rachh, Fund Manager, Equity Investments, Nippon India Mutual Fund. Samir, thank you so much for sharing your insights with our audience.
Thank you. Real pleasure interacting with you.
Thank you
so much.
Thank you.